Welcome back to Morning Trade Live. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange. So glad you're with us on this Monday as the market bouncing back slightly from the big sell-off we saw last week. We are also going inside out now on Domino's earnings. The stock is down today after its quarterly report. Dan Ahrens is with us, Managing Director, Portfolio Manager at Advisor Shares. And we saw same-store sales, not good news there, just a miss across the board. Some of your thoughts?
Yeah, disappointing, obviously, and the stock's down 4.5%, 5%. It was a miss versus analyst expectations, but not a big miss, and revenue and earnings are still growing. The total net revenue came in 1 penny below expectations. Net revenue also, or total revenue also grew, but less than analyst expectations. International was a little bit better than U.S., but in the U.S. we're seeing some of the headwinds that dovetails into what we're seeing with fast food elsewhere. Some of the fast food competitors coming in with discount meals and so on may be dipping into the sales that Domino's usually had been seeing in the past year, of people thinking fast food was very expensive. So a very mixed bag here.
I thought it was interesting you brought in some of the others because I haven't heard robust comments from many of the food companies. They all seem to be facing high costs, a consumer that is pinching the purse, maybe some uncertainty and challenges ahead. At the same time, you make a good point. They are still seeing revenue growth. Also noting, how about they raise the dividend 15%? And some of the analysts have targets that are higher here. I saw one at 490 today. TD Securities has a 490 target. It's at 434.
Yep. So the thing here is, again, this past quarter, a little bit disappointing, but not terribly disappointing. And we think Domino's is a very high quality company. Now, in our ETF, the Advisor Shares Restaurants ETF, EATS, we don't even hold Papa John's right now at all. And Yum Brands, which is Pizza Hut, is down at the very bottom of our portfolio, greatly underweighted. We at least have DPZ in the middle of our portfolio. It's not in the top 10. Because mostly we see other good opportunities in the restaurant space. And I've talked about this before. It involves some of the casual restaurants that are leaning a little bit more towards fast casual, some of the other fast casual names that are really threading the needle, if you will, of value versus price that the consumer can see. So it's very important to pick the right stocks in restaurants these days. Our restaurants ETF has been outperforming the S&P 500 year to date and last year. So it is about getting the right stocks.
Yeah, let's talk about Eats a little more. I think you made some good points there, noting that Papa John's not in there. You said Yum Brands is sort of middle of the road as far as where you have it positioned. What are some of the top holdings that have worked or maybe will continue to work? This as Eats is 1 year up about 24%. What are some of the names that do work for you?
Some of the best stories have been over the past year. It's really been Brinker. Brinker is, as many people know, Chili's. And they're offering this, $10.99, for 3-item value meal. It gets advertised a lot. They get people in the door, and then they can cross-sell and also have alcohol sales. An unusual name we have at the very top of our portfolio right now is Nathan's, Nath. Nathan's famous. People know about the hot dogs, but they also have restaurants in airports and other locations. So a very, small cap or micro cap name. But some of the, again, sit down, fast casual and casual restaurants, it's Brinker, it's Texas Roadhouse. We also like those companies like Sweet Green and Cava. And, they're kind of using the Chipotle model. We're avoiding true fast food quite a bit and avoiding some of the pizza names, although we have DPZ right in the middle of our portfolio still as a high quality operator.
So that stays alive in the eats, group. And I will also say a lot of these companies are facing some headwinds when it comes to currency. Maybe as the dollar pulls back a little bit, that might help.
Yeah, it's interesting that, we've talked about some of those fast food names, again, that we're avoiding or underweighting, but some of the really big ones have a lot of international exposure and then they have, currency risk, therefore. But companies like DPZ, again, the international sales growth was a little bit better than the US sales growth. And we've also seen that in some of the fast food names like Yum Brands and McDonald's and so on. So, yep, headwinds, but picking the right stocks, offering the value versus price to the consumer is really the sweet spot that has to be found right now.
It's interesting because I'm looking at the McDonald's chart, and I'm going to let you go here, but it's a lot of green, whether you look at month to date or 3 months or year to date or 1 year, but it's going nowhere fast. 1 year, it's up 5%. When the markets are gaining 20%, someone might say, hey, my McDonald's is up. I see a lot of green, but truthfully, it's underperforming the major markets. It's great to chat with you. Dan Ahrens of Advisor Shares looking at Eats for us, the ETF as well. Thank you for that. And Domino's Pizza. And then now we go inside out. This is where we turn to Tom White, co-host of Fast Market, because you take us through example trades. So we'll start with Domino's Pizza, which did have some misses. And while we saw some bright spots within the report, still the down arrow today. What would be an example trade today? Good morning, Tom.
Good morning, Nicole. Yeah, I think a lot of people maybe want to get into this name on the pullback that we've seen. It's still up about 5% so far this year, but this pullback provides opportunities for people that maybe have missed the rally or want to get into the stock despite the weaker than expected U.S. sales. Remember that, just as your guest said, international sales were still pretty good. But if that inflation concern continues, maybe Domino's recovers because it is a low price entry point for a family of four to feed themselves. So I looked at a strategy going out to the March monthly cycle. So 25 days to expiration, really short-term positioning. I'm going to take advantage of this sell-off and look at selling a short put vertical, sell the March 430 puts, and then to make it risk defined, I'm going to buy the 420 puts. So a short $10 wide neutral to bullish put vertical in DPZ. You're going to collect around a $4 credit on that if the stock's trading about 435 or so. And that takes your break even down to 426, where you start to lose money on this one. That's nearly 3% below the current share price in there. So you're giving yourself a cushion to the downside for protection, making it risk defined. You profit in 3 out of 4 scenarios. The stock can go higher, stock can stay where it is, even go a little bit lower, and you can still be profitable on this type of trade. You've got 3.5 weeks until expiration, so you have some duration for the stock to recover. But even if it just sits here, you get to collect that $4 credit.
All right. And by the way, folks, the markets just note S&P has turned negative now. Utilities, consumer discretionary, tech leading the way down. A lot of down arrows slightly to the downside. Let's turn our attention over to a name. Dan Ahrens said he liked Brinker, and you're looking at EAT here. Tell me about this one, which had a high recently of 192, has since pulled back, and you have an example trade. This is the parent of Chili's, right?
Yeah, it is. And Chili's was the reason the stock's doing so well. It's up over 220% over the last year. You can see there, we pulled back pretty significantly from those all-time highs that we saw just about a month ago. But this has been a real winner on the back of Chili's selling $10 meals to people. And maybe that's against that inflationary pressures that we're seeing in a lot of other restaurant stocks at this point. So we have seen that pullback, maybe some consolidation warranted. We filled the gap from the gap up. We filled that to the downside on this sell-off that we've seen because their last earnings report was pretty spectacular on the same-store sales, especially in the Chili's division. So I looked at something a little bit more neutral where you can just take advantage of maybe some consolidation warranted in this name using the option market. So I looked at a short iron condor here, went out to that same March 21st monthly cycle, so 25 days to expiration, where I'm going to sell an out-of-the-money put vertical, and that'll be the 135, 130 put vertical. And then on the upside, on the call side, I'm going to sell the 160, 165 call vertical. So a short $5 wide neutral iron condor here. I'm going to collect roughly about a $2 credit with the stock trading right here. So that takes my break evens to 133 on the downside and then 162 on the upside. Anything within those two break evens is going to be profitability on this type of trade. You just don't want any outsized moves past either the 130 strike or above the 165 strike to remain profitable on this one. It's positive time decay, so this position will contract in value on a daily basis, so it's positive theta on this one. You just hoping for some consolidation after a pretty big monthly move to the downside here where it filled that gap.
All right, Tom White, thank you. A good look there at Domino's Pizza and Brinker as well. We appreciate it, Tom White.